The Warren Buffett Way, by Robert G. Hagstrom. Introduction. Imagine it's the 1960s. A company in New Jersey, dealing in salad oil, seems to be doing incredibly well. So well, in fact, that major financial institutions, including the respected American Express, are lending it millions of dollars against its inventory. The collateral is simple: massive storage tanks filled with valuable vegetable oil. Inspectors come, they dip their measuring sticks into the tanks, and everything checks out. The loans keep flowing. But one day, the whole thing comes crashing down. It turns out the company was a fraud. Its leader, a man named Tino De Angelis, had discovered a simple trick of physics: oil floats on water. His giant tanks were mostly filled with worthless seawater, with just a few feet of salad oil floating on top. When the inspectors came, they only ever measured the top layer. The collateral was a mirage. When the scandal broke, the market panicked. American Express, which had guaranteed the loans, was on the hook for a staggering amount of money. Its stock price was cut in half overnight. Wall Street was terrified. Everyone was selling, convinced the company was doomed. But in Omaha, Nebraska, a young investor saw something different. Instead of looking at the screaming headlines and the falling stock price, he started asking simple questions. He went to local restaurants and watched people pay for their meals. Were they still using their American Express cards? Yes. He visited banks. Were people still buying American Express travelers' checks for their vacations? Absolutely. He realized the scandal, though serious, hadn't damaged the core of what made American Express a great business: the trust people had in its products. While everyone else was consumed by fear, he was looking at the reality of the business. So he invested a massive portion of his fund, 40% of it, into the beaten-down stock. Over the next 2 years, his investment tripled, earning his partners millions. That young investor was Warren Buffett. And that story tells you almost everything you need to know about the man who would become the world's greatest investor. It wasn't about complex formulas or risky bets. It was about thinking differently. It was about seeing a business where others only saw a stock ticker. Today, we're diving into The Warren Buffett Way by Robert G. Hagstrom. This book has sold over 1 million copies for a simple reason: it decodes the mindset of a genius. Hagstrom spent years studying Buffett's letters, investments, and philosophy, and he distilled it into a set of timeless principles. My promise to you is this: by the end of our time together, you won't just know what Warren Buffett buys. You will understand how he thinks. You'll have a mental framework that you can apply not just to investing, but to making decisions in any area of your life. We're going to uncover the simple, profound logic that allowed a man from Omaha to turn a $100 investment into one of the greatest fortunes in human history. Book summary. To truly understand the Warren Buffett way, you have to start at the beginning. Not with the billions, but with a boy fascinated by numbers. As a child, Warren wasn't playing with toys the way other kids did. He was sitting on his porch, meticulously recording the license plate numbers of passing cars. He was spreading the newspaper on the floor and counting how many times each letter of the alphabet appeared. He was a calculating machine, obsessed with patterns and probabilities. His first real business venture was simple. He'd buy a 6-pack of Coca-Cola from his grandfather's grocery store for 25 cents, and then go door to door selling each bottle for a nickel. A 5-cent profit on a 25-cent investment. He was already thinking in terms of return on capital. This obsession with making money and watching it grow led him, at the tender age of 11, to make his first stock purchase. He and his sister Doris bought 6 shares in a company called City Service. He'd studied the price charts, he felt confident. But then, the stock dropped. His sister, Doris, panicked. Every single day, she reminded him of their loss, of the money they were watching disappear. The emotional pressure was immense. So, the moment the stock recovered and they had a tiny $5 profit, Buffett sold. And then he watched in agony as that same stock soared to over $200 a share. It was a painful lesson, but perhaps the most valuable of his life. He swore two things to himself that day. First, he would never again let the price he paid for a stock dictate his decisions. And second, he would never settle for small, quick profits. He learned, at age 11, the incredible power of patience. But he still needed a framework, a true philosophy for investing. He found it in a book he discovered at the library, The Intelligent Investor by a man named Benjamin Graham. For Buffett, reading that book was, in his words, like seeing the light. Graham became his mentor, first through his writing, and later as his professor at Columbia University. And Graham taught him the two ideas that would form the bedrock of his entire career. The first was an allegory, a story about a business partner he called Mr. Market. Imagine you own a piece of a wonderful business, and every day, your partner, Mr. Market, shows up at your door. The thing about Mr. Market is, he's emotionally unstable. Some days he's euphoric, convinced the future is glorious, and he offers to buy your share of the business for a ridiculously high price. Other days, he's deeply depressed, certain the world is ending, and he offers to sell you his share for a laughably low price. Graham's point was this: you don't have to listen to him. You can use his mood swings to your advantage. When he's depressed and offering you a bargain, you buy. When he's euphoric and offering you a crazy price, you can sell. But you never, ever let his mood dictate your own feelings about the business. The market is there to serve you, not to instruct you. You are the owner of a business, not a gambler betting on a ticker symbol. This leads to Graham's second, and most famous, idea, the margin of safety. It's a beautifully simple concept. Your goal as an investor is to figure out what a business is truly worth, its intrinsic value. Then, you wait patiently until Mr. Market, in one of his depressed moods, offers to sell it to you for significantly less than that value. That difference, that discount between the real value and the price you pay, is your margin of safety. It's your protection against bad luck, errors in judgment, and the unpredictable swings of the economy. Armed with these ideas, the young Warren Buffett went out into the world. In the early days of his investment partnership, he was a pure Graham disciple. He was what he later called a cigar butt investor. He'd look for companies that were so beaten down, so unloved, that they were trading for less than the cash they had in the bank. Like finding a cigar butt on the street with one last free puff left in it. It might not be a quality smoke, but it was free. This strategy worked beautifully. His partnership posted incredible returns, crushing the market averages year after year. But as the years went on, Buffett started to realize the limitations of this approach. Buying a mediocre business, even at a wonderful price, often left you with, well, a mediocre business. Time, he discovered, is the friend of a wonderful company, but the enemy of a mediocre one. This is where the story takes a turn. This is where Warren Buffett evolves. And his evolution was guided by two other intellectual giants, Philip Fisher, and, most importantly, his partner, Charlie Munger. Philip Fisher was the polar opposite of Ben Graham. While Graham buried himself in financial statements, looking for quantifiable bargains, Fisher was out talking to people. He believed that to truly understand a company, you had to investigate every aspect of it. He developed a method he called scuttlebutt. He'd talk to a company's customers, its suppliers, its former employees, even its competitors. He wanted to understand the qualitative aspects. Was this a great business with a durable competitive advantage? Was its management not just smart, but honest and trustworthy? Fisher wasn't interested in buying fair companies at wonderful prices. He wanted to buy wonderful companies at fair prices. This idea was a seed planted in Buffett's mind. But the person who truly made it grow, who pushed Buffett across the intellectual Rubicon, was Charlie Munger. Munger and Buffett, both from Omaha, were a perfect match. Munger was brilliant, with a wide-ranging intellect that drew from psychology, history, and science. And he constantly challenged Buffett's thinking. It was Munger who famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." The pivotal moment in this evolution came with a company called See's Candies. In 1972, Buffett and Munger had the chance to buy this beloved West Coast candy company. By every Ben Graham metric, it was a terrible deal. The asking price was 3 times its book value, 3 times the value of its physical assets. The cigar butt investor in Buffett was screaming no, it was just too expensive. But Munger saw something else. He saw a business with a powerful brand, a loyal customer base that would happily pay a little more each year for their favorite chocolates, and a simple economic model that gushed cash without needing massive reinvestment. He saw a wonderful business. He convinced Buffett to pay the price. They bought See's Candies for $25 million. It was, as Munger later said, the first time we paid for quality, and it changed everything. That $25 million investment has since generated over $2 billion in earnings for Berkshire Hathaway, Buffett's company. See's Candies taught Buffett a profound lesson. The real value of a business isn't just in its tangible assets, like factories and inventory. The real, enduring value often lies in the intangibles, the strength of its brand, the loyalty of its customers, its pricing power. Ben Graham's margin of safety was still the guiding star, but the definition of value had expanded. This synthesis of Graham's price discipline and Fisher and Munger's focus on quality created the modern Warren Buffett way. It's a philosophy built on a set of clear, powerful principles, what the author Robert Hagstrom calls the 12 immutable tenets. We don't need to go through all of them like a checklist, but we can understand them by seeing how Buffett thinks about an investment. He groups them into 4 simple categories. First, he looks at the business tenets. The very first question he asks is the business simple and understandable? Buffett famously calls this his circle of competence. He knows he doesn't have to be an expert on every industry. He just has to know the boundaries of what he does understand. He understands the business of selling soda, or insurance, or furniture. He understands businesses with long track records. That's why, for decades, he avoided technology companies. It wasn't that he thought they were bad businesses, it was just that he felt he couldn't confidently predict what they would look like in 10 or 20 years. And if he can't predict, he won't invest. Next, he asks, does the business have a consistent operating history? Buffett isn't interested in turnarounds. He says turnarounds seldom turn. He'd much rather buy a great business that's been consistently successful for years, even if it's going through a temporary, solvable problem. And finally, the most important business tenet, does it have favorable long-term prospects? This is where he looks for what he calls an economic moat. A moat is a durable competitive advantage that protects a business from its competitors, just like a moat protects a castle. A powerful brand, like Coca-Cola's, is a moat. A low-cost operation, like Geico's, is a moat. Having a product that people are locked into, what we call high switching costs, is a moat. The wider and more sustainable the moat, the more Buffett loves the business. He wants a castle protected by crocodiles and piranhas. Once he's confident about the business itself, he moves on to the management tenets. He wants to know, is the management rational? For Buffett, the single most important job of a CEO is capital allocation, deciding what to do with a company's profits. A rational manager will only reinvest earnings back into the business if they can generate a high rate of return. If they can't, they should return the money to the owners, the shareholders, by buying back stock or paying dividends. He despises managers who use company cash to make dumb, ego-driven acquisitions just to build a bigger empire. He also asks, is management candid with shareholders? Buffett reads annual reports like a detective. He wants managers who are honest, who admit their mistakes as openly as they celebrate their successes. He says the CEO who misleads others in public may eventually mislead himself in private. And finally, he looks for managers who can resist the institutional imperative. This is a powerful concept. It's the lemming-like tendency of corporations to mindlessly imitate their peers. If every other company in the industry is making a foolish acquisition, the institutional imperative pressures the CEO to do the same, even if it makes no sense. Buffett looks for independent thinkers who are willing to look foolish in the short term to be right in the long term. After evaluating the business and its management, he turns to the financial tenets. He doesn't get lost in complex metrics. He focuses on a few key things. He prioritizes return on equity (ROA), not earnings per share (EPS). He says any company can grow its earnings per share simply by retaining its profits. That's like getting excited that your savings account is bigger this year because you left the interest in it. Return on equity, on the other hand, tells you how effectively management is using the owner's capital to generate profits. And he wants to see high returns achieved with little or no debt. He also calculates what he calls owner earnings. This is his version of true cash flow. It's the company's net income, plus non-cash charges like depreciation, minus the average amount of capital expenditures the business needs to maintain its competitive position. This gives him a realistic picture of the cash the business can actually generate for its owners year after year. And, of course, he looks for companies with consistently high profit margins. This is a sign of a strong business and a cost-conscious management team. Finally, we come to the market tenets, the two questions that tie everything together. First, what is the value of the business? This goes back to the core of his philosophy. He defines the value of any business as the total of its future owner earnings, discounted back to what they're worth today. It's a simple idea, but it forces you to think like a long-term owner, not a short-term speculator. And only after all of that, after analyzing the business, the management, and the financials to determine a conservative estimate of its intrinsic value, does he ask the final question, can I buy it at a significant discount to its value? This is the margin of safety. This is where Graham, Fisher, and Munger all come together. He's looking for a wonderful business, run by great people, that he can buy for a price that gives him a substantial cushion. When you put all these pieces together, you see that Buffett's process naturally leads him to a very specific style of portfolio management, one that is the complete opposite of what most of the financial world practices. It's called focus investing. Most investment advice tells you to diversify, to spread your bets across dozens, or even hundreds, of stocks. The idea is that if one investment goes bad, it won't hurt you too much. Buffett thinks this is nonsense for someone who knows what they're doing. He says, diversification is protection against ignorance. It makes very little sense for those who know what they're doing. His argument is simple. Why would you put money into your 20th best idea when you could put more into your absolute best idea? His philosophy forces him to be incredibly selective. He might only find one or two truly great investment ideas in a year. When he does, he bets big. Berkshire Hathaway's portfolio has often had the majority of its money in just a handful of companies. This requires incredible conviction and patience. It means you must be willing to sit still, sometimes for years, holding cash and waiting for the perfect pitch. As he says, the stock market is a no-called strike game. You can stand at the plate and watch pitch after pitch go by, the high flyers, the speculative fads, the hot new thing, and it doesn't count against you. You only swing when you see a pitch right in your sweet spot, when you are absolutely confident you can hit out of the park. This approach, this deep, business-focused analysis combined with a concentrated, patient portfolio, is the engine of his success. But there's one more piece to the puzzle, and it might be the most important of all. It's the psychology of investing. Buffett's true genius isn't just his analytical ability. It's his temperament. It's his mastery over the two emotions that wreck most investors: fear and greed. He remains rational when everyone else is panicking. He stays disciplined when everyone else is caught up in a speculative frenzy. He learned from Ben Graham that the market's mood swings are an opportunity, not a threat. And he learned from Charlie Munger the countless ways our own minds can trick us. We are prone to overconfidence, we hate admitting we're wrong, and we have an irrational fear of loss. Studies show that the pain of losing $1 is more than twice as powerful as the pleasure of gaining $1. This loss aversion causes people to sell their winners too early to lock in a small gain, and hold on to their losers far too long, hoping they'll break even. Buffett is immune to these psychological traps. He doesn't care if a stock he owns goes down after he buys it, as long as the underlying business remains strong. In fact, he loves it. It gives him a chance to buy more of a great thing at an even better price. He's not buying a stock ticker, he's buying a piece of a business. And as long as the business is doing well, he knows that eventually, the market price will catch up to the business value. His favorite holding period, as he famously says, is forever. This isn't just a clever line. It's the ultimate expression of his philosophy. When you buy a piece of a truly wonderful business, run by people you trust, at a sensible price, why would you ever want to sell it? You simply let the power of compounding work its quiet, relentless magic over decades. That is the Warren Buffett way. It's not a secret formula. It's not a get-rich-quick scheme. It is a philosophy of thinking. A commitment to being a business owner, not a speculator. A discipline of patience, rationality, and independent thought in a world that rewards the opposite. It is, at its heart, profoundly simple. But as Buffett's unparalleled record proves, it is also profoundly powerful. Commentary. So, what do we take away from all of this? When you step back from the stories and the principles, I think the most powerful lesson in the Warren Buffett way is a deeply liberating one. It's the idea that success in investing has very little to do with being the smartest person in the room. It's not about having a PhD in finance or building complex algorithms. It's about temperament. It's about having the right mindset. Buffett himself says, investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Rationality is essential, and that's a game anyone can learn to play. You don't need to be a genius, but you do need to be disciplined. You need to cultivate patience in a world that demands instant gratification. You need to have the humility to admit what you don't know, and to stay within your circle of competence. The world of finance can feel intimidating, designed to make you think you need an expert to navigate it. But Buffett's entire philosophy is a rebellion against that idea. He demystifies the process. He brings it back to common sense. You're not buying a complex financial instrument, you're buying a piece of a business. And if you can't understand that business, how it makes money, why customers choose it, and what its future looks like, then you have no business owning it. It's that simple. So, how can you start applying this way of thinking, right now, even if you're just starting out? First, practice the principle of the circle of competence. Take a piece of paper and write down the industries or businesses that you genuinely understand. Maybe you work at a coffee shop and you understand the economics of that business better than anyone. Maybe you're passionate about video games and you have a deep insight into which companies have the most loyal fan bases. Start there. Your knowledge is your edge. Don't be tempted to venture into areas you don't understand, no matter how exciting they seem. Second, become a business analyst, not a market analyst. The next time you hear people talking about where the stock market is headed, or what the Federal Reserve is going to do, consciously tune it out. Instead, pick one company that interests you, one that's within your circle of competence, and read its annual report. Read the CEO's letter to shareholders. Try to answer Buffett's core questions. Is this a good business? Is it run by honest and able people? And is it available at a sensible price? This shift in focus, from market speculation to business analysis, is the single most important step you can take. And third, cultivate patience. This is perhaps the hardest, but most rewarding part. Recognize that real wealth isn't built overnight. It's built over decades, through the slow, steady power of compounding. When you make an investment, think of it as a 10-year commitment. This long-term mindset will free you from the emotional roller coaster of daily market fluctuations and allow you to focus on what truly matters, the performance of the underlying business. The Warren Buffett Way isn't just a book about investing. It's a book about a way of thinking. It's about clarity, discipline, and the quiet confidence that comes from doing your homework and trusting your own judgment. It's about playing the long game in a world obsessed with short-term scores. And that is a lesson that will serve you well, not just in your portfolio, but in every aspect of your life. That was a summary of The Warren Buffett Way by Robert Hagstrom. We've explored the core of Buffett's philosophy today, but I'll be honest with you, a summary is like looking at a photograph of a great meal. You can see what it's made of, but you can't truly experience the flavor. The real magic happens when you read the book for yourself. It's in the detailed case studies, the subtle insights, and the way the principles build on one another. This summary is designed to help you decide if this book is worth your time. If anything we've talked about today has sparked your curiosity, I encourage you to grab a copy. Reading it isn't just learning, it's an apprenticeship with the greatest investor of all time. You'll find a link to the book in the description below. Also, if you found this summary valuable, please hit that like button and subscribe to our channel. It tells us we're on the right track and ensures you won't miss our next journey into another life-changing book from the Billionaire's bookshelf. Let's keep growing together.